Hello and welcome back to another video here at FiscalVoyage. In this video, we're going to talk about Netflix stock. Netflix just announced their Q3 earnings release, and we're going to talk about it, do a deep dive on the news report and what's going on and some of the valuation for Netflix. Right now, the company looks to be down about 6 to 5% after hours because of the fact that the net add of users was lower than expected. But before we get started with that, if you're new to the channel, make sure to hit that subscribe button, as well as check out my free ebook in the description below. The third quarter earnings or press release, Netflix down 6% on lower net adds. First off, Q3 GAAP earnings came in at $1.74, missing by basically 40 cents. Revenue up at a very nice rate of 22.7%. Beats it by 60 million, and this is what's bringing the stock price down. Net adds of 2.2 million to now currently 195.15 million versus a guidance of 2.5 million. So analysts were expecting a net add of 2.5, and the company just added new customer 2.2 million. So this is what bringing the shares down by 6%. So let's look at the earnings report. So you can see here, as expected, growth has slowed with 2.2 million paid net adds in Q3 versus 6.8 million in Q3 in 2019. We think this is primarily due to our record first half results and pull forward effect we described in our April and July letters. So here you can see some of the breakdowns. Revenue has been growing very nicely. You can see here year over year in Q3 2019, 31% growth, and Q3 20 just announced 22.7% growth. So, and they're forecasting 20% revenue growth for Q4. So that's still very nice revenue growth. Operating income has been growing nicely as well. Operating margin is more or less in line. You can see here there's been quarters where operating margin was lower. 8.4% here, 16.6% in Q1 2020. Recently, now 20.4% in operating margin, and they're expecting it to be down 13.5% in Q4. Net income has been growing. You can see here very nicely at a very nice rate. Net income is expected to be down for Q4. However, this is kind of what's also bringing the stock down. If we look at this net earnings for the subscription, you can see here in March, January, February, March, the growth of subscription was more or less similar to the other years. You can see here. And then April, with the lockdowns and stuff, you can see this huge growth in new ads or new users signing up to Netflix. And they're expected this continued growth for the 2020s. You can see here, estimated forecast is higher, around 35 million or so new users. And here's a nice picture as well. As you can see here, Q1, these were forecasted, and then this is what actual. So they were forecasting 7 million net new users, and they got 15.8 million. Q2, 7.5 million forecast, they had net new 10.1 million, and then this quarter they estimated 2.5 million and only obtained 2.2 million. So it looks like there've been times where the estimates were lower, or the actual were lower than the estimates, but overall they continue to grow their net users. So you can see here, right now they have 195 million users versus Q2 192 million users. So there's a nice increase year over year. At this time they had 158 users paid memberships, and this is an increase of 23%. Still very good growth year over year. Forecast, they're estimating 201 million users, 20% growth from fourth quarter of 2019. But overall, they're still growing the user count. So this might present a buying opportunity, I think, because you can see here, analysts have the stock down, or the futures after hours is down about 5%. I'm going to talk later more about what's a good price range. But right now, I think anything under 300 for Netflix right now is pretty expensive. We'll go more in detail in that. But overall, they did have a good quarter. Income is up, revenue is up, The only bad side was the net added users. So look at some of the cash flows. You can see here net cash generated by operating activities in Q3 was 1.3 billion, a positive, versus a loss of 502 million in Q3 of 2019. Free cash flow also was positive for the third consecutive quarters at 1.1 billion versus a loss of 551 million in Q3 2019. Free cash flow year to date is up 2.2 billion versus 1.6 billion loss in the first 9 months of 2019. So they're making income, and I think it's because of the fact that the operating expenses dropped because they're not making new films because of COVID, so they had to stop production. But people were still signing up, to look at their already content that they already had. So that's something to look at. Let's look at the 9 months, and this is the income statements. You can see here revenue at 18 billion versus 14 billion for the first 3 months of fiscal 2019 versus fiscal 2020. So that's very good there. Operating income came at 3 billion versus 2 billion. Net income almost double of net income from 2019 the first 9 months to 2020 first 9 months. So you can see here diluted earnings came in at $4.89, almost double as well, from $2.83 for the first 9 months. So this is very good net income report. So look at the balance sheet. Here, cash and cash equivalents, as we talked about, increased almost 3 billion there. That's good. Total current asset jumped almost 3 billion. That's positive there. I like that. Total asset increased almost 5 billion. This is positive. So this is the asset part of the balance sheet looking good. So total current liabilities came in about 8 billion. It's higher than last year, but the fact that they have 8.3 billion or 8.4 billion, they could pay off in cash. They could pay off all of this debt, current liability instantly. So that's very positive there. Total liability did increase from 26 billion to 28 billion, about $2 billion increase. Equity, total stockholder equity increase as well as positive there. So you can see here net income almost double of last year first 9 months. As you can see here, additions to content assets. This is the creation of like new movies or shows or documentary stuff like that. You can see here's a decrease from almost 10 billion to now 8.4 billion. So over here you can see here cash from operation positive 2.5 billion versus a loss of 1.4. Minusing capex here 349. So you have a lot of free cash flow here, very positive for Netflix. And the cash and cash equivalents increased dramatically from the beginning of the quarter, almost 3 billion to the end of the quarter. So that's very positive. So you can see the difference there. So overall, the company performed very well. The only thing that's drawing the stock down right now after hours is the net, lower than actual forecast, the net actual of 2.2 million net new users. So if we look at Morningstar for Netflix, you can see here Morningstar provided a 1-star rating, which is a sell rating, because Morningstar has a fair value price about $200. I think the fair price is slightly higher than that. We'll go over that more in detail, but right now it's yesterday closed for $530. We look at some of the key ratios. Revenue growth, as you can see, as I mentioned, outstanding 31% revenue growth for the past 3 years. Net income growth, even better at 115% net income growth for the past 3 years. If we look at some of the debt, you can see debt to equity ratio is decent at 1.69. Again, they have a lot of free cash available to pay off the current debt, so that's very positive. Interest coverage at 5.21, so the company balance sheet is looking very good. So if we look at some of the valuation metrics here, you can see here current price to sell is high at 10.6 versus a 5-year average of 8. You can see here 8 or 6. Those were like good buying opportunities, of course. Price to book is high as well. PEG ratio is pretty high. I like to see this at 2 and lower. You can see here 2.31 versus the 5-year average. So it's better currently versus the 5-year average, but I like to see a nice PEG ratio. You can see here under 2 in 2017 and 2018. And if we go to Yahoo, you can see here 5% after hour decrease. Analysts are expecting next 5-year earnings to grow at 35%. So we're going to use this 35%, 40% growth to determine a decent fair value price. Since analysts are expecting about 30 or 35%, I'm going to use a 30 earnings growth, for the next year or this year. As you can see here, analysts for Yahoo average price is 529, with currently is 525, so it's fair price based on Yahoo. But if we look at FastGraph, you can see here they're expected to earn about $6.20 in adjusted earnings. If we go to the expected earnings of $12.19, you can have a nice total annual return, about 27.8%. Again, but this is based on a growth rate of 74%. And as you saw in Yahoo and the financials earlier, it looks about 20%, maybe 25% growth rate. But I'm going to use 30%. And if we get a calculator out, and if analysts are expecting $6.20 for this quarter or for this year times 30 PE, we get a fair price about 186. So that's very, very low. I personally think a fair price under 300. So let's use 2021 expected earnings of $8.90 times 30. We get about 267. So 267 is what I would consider fair price. Again, the value price for Netflix right now is 530. This is from yesterday's closing price. It is expected to be down, but I think personally this is fair price. I think personally anything under $300 will be a buy for Netflix. But right now I'm personally not interested in buying Netflix. I think a price of $300 would present a nice buying opportunity. Anything under 300, if it could get into 350, maybe dip your toes into it. But right now it looks to be overvalued. But I think anything under 300, 350 looks like a good buying opportunity for Netflix. So those were my thoughts on Netflix currently. It looks to be very overvalued. I think with this 5% decrease, it might start dropping lower and lower as the days and weeks go on. I personally would like to buy this company at around $300 to $350. I think those will present a good buying opportunity because of the fact that the company is expected to grow at a very high rate of about 20%, 30%. So that's very positive there. It's just a valuation I'm not liking right now. So overall, Netflix did have a good quarter in my opinion. The only bad news was the net adds of 2.2 million of new users compared to what analysts and what they were expecting. But overall, they did have a good quarter. So thank you for watching. If you're new to the channel, make sure to hit that subscribe button, as well as check out my free ebook in the description below. And I'll see you guys in the next one.